Depending on who wins the election, the outcomes could have a big market implications. Joining us now, we want to bring in Kurt Reiman. He is UBS Global Wealth Management ElectionWatch colleague. Kurt, it's great to have you. We certainly have seen this swing just in terms of what the markets are pricing in. You can see that playing out in the dollar. You can see it playing out even in yields, maybe to some extent, just in terms of what a Trump presidency could bring when it comes to lower taxes, when it comes to tariffs. What is the number one thing that investors need to keep in mind heading into Election Day in terms of policy implications for their portfolio?
Thanks very much for the opportunity to join you, and it's a great starting question. This week, it seems it's all elections all the time. I guess I kind of try to put this into the larger context. The bond yields have risen. We've seen the dollar strengthen some. Financials have had a nice run. All of these together, I think you could say, are somewhat attached to the recently higher probabilities of a Trump victory. But then what about the fact that over this past month, when we've seen all of these trends in financial markets, what about the fact that the Fed had been expected to cut rates more aggressively? There was, this idea that maybe the U.S. economy wasn't quite as vibrant. We've been repricing off of that and changes around this idea that actually the U.S. economy is in better shape. Earnings, as I'm sure you've talked about with a number of guests, have been quite strong. Companies are beating expectations, especially the financial companies. You think about the earnings next year, which are still growing at around 8%. So what I think about is that the handoff to the next administration, this sort of baton pass, whoever wins, is going to be inheriting an economy that's in pretty good shape. And when you think about some of the stimulus that we're seeing coming from places like China and rate cuts in the rest of the developed world, with the exception of Japan, well, this I think, is a pretty good setup. So in a way, it's sort of the Hippocratic oath here. At first, do no harm. But then, there's much more we could talk about on the election. But I would just say, look, right now, the economy is in pretty decent shape. And while I wouldn't pour cold water on the idea that maybe these Trump trades are leading to some of the changes in financial markets, I wouldn't rule out that it's also coming from the growth backdrop, the fundamentals. They support this move as well.
Well, Kurt, it's interesting to talk about some of the specifics within policy. One thing I'm interested in is that mortgage rates never cracked 5% during Trump's first term. And obviously, that's a very different backdrop this time around. How do you think that backdrop could potentially impact what a Trump presidency could look like, and how his economic policies, fiscal policies, I should say, could kind of fight against what's happening in terms of mortgage rates right now?
We haven't seen a whole lot from the Trump administration on what might happen to bring about a change in the demand and supply balance in housing, which, as we know, is very tight. We are seeing higher interest rates in the last couple of weeks. I think there is some concern that there may be a move higher in rates on a Trump presidency, especially initially, and that would be led by the back end of the yield curve. I mean, I guess I would say here that when it comes to policies, we have to keep in mind that the next administration is also going to face a number of constraints. I mentioned that the handoff to the next administration is likely to be a good economy, but also let's not forget deficits are high, debt loads are also rather high, and there are still some fiscal hawks or fiscal conservatives within the Republican Party. There's also the possibility that we don't see united government under Trump. We think it's a 1 in 3 shot at divided government under Harris. We think it's almost virtually going to be divided government. So that puts a little bit of a constraint on the ability of the White House to get its policies through the legislative branch. And then I'd also point to something that's a little bit more, sort of inside baseball around D.C. But last summer, there was a decision by the Supreme Court to sort of rein in a little bit the interpretation of legislative statutes. It was this reversal of Chevron deference. That's something that we don't often hear a lot about, but In terms of regulatory reach from the administration, that's also likely to be constrained, whether it's a Harris or a Trump presidency, probably in different ways.
What do investors need to prepare for over the next 2 weeks? We talked about the uptick in volatility. We've talked about the potential of a contested election, what that would add just in terms of the uncertainty. How much of that is going to play into the volatility aspect, and how should investors, or should they be making any adjustments today to prepare for that?
I think that's a great point. So also, when we think about some of the market moves recently, and we know that volatility is usually elevated heading into an election, this year is no different, then what we should say about that is that some of the financial market outcomes that we're seeing are perfectly reasonable within the context of this elevated volatility that we're seeing. But then, on top of that, yes, you bring up this point of a contested election. We have a very narrowly divided country. The polls are telling us this. The prediction markets are not, and that's kind of an interesting sort of dichotomy with what's happening. But the polls are very tight. There are 4 swing states where the margin is within a percentage point. So this is kind of continuing along recent trends. And so I guess I'd say is that if we have this narrowness in the country, there is a possibility that we have to wait days or weeks for an outcome. Does that mean that we should make portfolio shifts in advance, large strategic shifts? No, we don't want to mix politics with our portfolio, but there are things that investors can do that may be helpful. One example is we like gold over the next year. And not just because of election volatility, it's because central banks are shifting their reserves. With a 2,900 price target, that's an asset that investors can add to their portfolio that may provide a little bit of ballast. Another example is utilities. Here's a sector that does well almost all weather. It's a more stable dividend payer. And yet there's also this artificial intelligence enhancement of increased electricity demand that's sort of a structural driver for utilities. So adding on a little bit of dividend ballast from utilities, not such a bad move here. We like it anyway. We like it through the election. I can keep going, but I guess the point is that making some tactical shifts in the portfolio to add a little bit of robustness to it going into what may be a contested election. It's not a bad idea, but what I would not recommend is large portfolio shifts because of concerns about the risk of a contested election.
All right, Kurt, giving us a lot of great investor positioning to think about after this election. Thanks so much for joining us, Kurt Reiman over at UBS.